Okay, for week 7 of class, we are going to talk about leases. And there was a new accounting standard that was implemented at the beginning of 2019 regarding leases. And that is ASU 2016-2, which has been codified into ASC 842. And we will talk about the new lease standard for the purposes of our homework problems and our quizzes. However, I do want to point out that because this new lease standard was effective for 1/1/2019, and most companies applied a modified prospective approach, if you are looking at a company's 10K who ended, who has a calendar year end, so therefore their financial statements are as of December 31st of 2018, that they would not be using the new standard, they would actually be using the old standard. However, you will notice a significant amount of disclosure within the financial statements regarding this new lease standard. So what we're going to cover today are some basics over leases, so some characteristics of what makes a lease a lease. We will talk about the capitalization requirements. So in order to capitalize the lease as a financing lease, what needs to happen? We will look at lease accounting from both the lessee and the lessor perspective. And the way that lease accounting works is you test to determine whether or not you have a financing lease. And if you don't have a financing lease, then you end up having an operating lease and account for it then as an operating lease. So we'll talk about lessee and lessor accounting when you have an operating lease. And then we'll take some time to look at some special lease considerations. What do you do when you have residual values that are guaranteed or unguaranteed? Some other adjustments that occur with leases, and then finally some disclosure requirements. So first of all, let's talk about what a lease is. Many of you may be familiar with leasing from a personal perspective. So for example, you may have leased a car, or you may have leased at a house or an apartment, and oftentimes when we think about it in terms of home rental, it's usually referred to as rent, but rent and lease can really be used interchangeably. So in general then, a lease is a contractual agreement between a lessor and a lessee. So the lessee is the person who is renting or leasing the property or equipment, and the lessor is the one who has the property or equipment and is giving that up for a particular amount of time in exchange for some cash consideration. So the arrangement gives the lessee the right to use specific property. I use property as a general term. It can literally be property, it can be equipment, it can be a building, it can be land, etc. And that property is owned by the lessor, and the lease arrangement is always for a specific period of time. In order to compensate the lessor, the lessee is going to make periodic rental payments or lease payments. And generally speaking, obviously there are a number of people who are lessors, but in general, lessors are comprised of one of three categories: banks, captive leasing companies, and independents. And so banks have historically been the largest players in this market because they have the access to low-cost funds that they can use to purchase the underlying assets that are going to be leased. So they can purchase buildings or land or various other assets. And the reason that they have all these funds is because people go and deposit their money in their financial institutions in order to earn a return, and in the meantime the banks use some of that money to make investments or to try to enhance the value of those assets. Captive leasing companies are another large player in the market, and captive leasing companies tend to be subsidiaries of other companies whose primary business is to perform the leasing operation for the parent company. So a really good example of this would be like Ford. So Ford Motor Company, right, they are in the business of manufacturing and selling vehicles. However, there would be a subsidiary within Ford who would have the leasing arm of the business. And the reason for having captive leasing companies is because they have what's known as a point of sale advantage. So you go to a Ford dealership, right, and you want to buy a new Ford truck, right? But you don't have the $40,000 in your pocket today to buy that Ford truck. So you might go and get a loan from the bank that you bank with, or you might decide to use the Ford financing that's available because they're going to give you a good rate and they're going to take more money off the cost of the truck, etc. So the advantage that captive leasing companies have are the point of sale advantage because they're basically providing another service that is complementary to the service that the car manufacturer itself is already providing, and they also have product knowledge, right? They're well positioned to be of significant benefit and also create ease and efficiency for the end customer. And then finally, the last category that we have are independents. And independents are not as prevalent as they once were. They struggle with the low cost funding. They also don't have a point of sale advantage. But what they can offer are innovative contracts. So they have a little bit more leeway in sort of tailoring contracts to meet the needs of the customers. And occasionally, independents might also act in a capacity like a captive leasing company if there is a parent company that doesn't have an arm that does leasing for them already. So what are some advantages of leasing? So if we first look at the advantages of the lessee, one of the major advantages and why a lot of people consider leasing is that you have 100% financing at fixed rates. If you think about an example, if you go and lease a car, oftentimes you have to pay a very minimal percentage down in order to take that car off the lot. And so with that kind of thought in mind, as a company thinks about leasing, because they often have to put very little money down, it can help the lessee conserve cash, right? So if they're cash strapped, but they need this equipment or they need this building in order to continue their operations, it can be a very efficient way of being able to run their business without having to pay out a lot of cash all at one time. You also get protection against inflation and increases in the cost of money, or what that really means is interest rates, because once you've signed a lease agreement, those payments are fixed and they cannot go up for the duration of the lease term. As a lessee, you also get protection against obsolescence, right? So lease agreements stipulate you're going to have this car for 3 years. At the end of the 3 years, you're going to turn it back in, and you basically get to wipe your hands clean of the transaction. Whereas for the lessor, right, if the car is no longer worth anything, right, they're stuck with that ultimate write-down, not the lessee. Leases also can be flexible. Lease agreements usually have less restrictive provisions. So if you think about it, you need a warehouse for your business. Two options are you can go to the bank and borrow money to pay for the building, or you can enter into a lease arrangement where you make periodic lease payments in order to use the building. Well, if you picked the former, the arrangement with the bank, your debt agreement often is going to have more restrictive provisions. Periodic audits might be requested. You might have to provide the financial statements to the bank, etc. So typically contracts for leases are less restrictive and, again, can be tailored more towards the needs of the lessee. And then finally, you see this primarily with startup companies or companies that are operating at a loss when it comes to taxable income. But depreciation deductions, which you are allowed to take when you own assets, often provide no benefit to companies who are running in the red, aka have little to no taxable income. And so instead of you being unable to use these tax deductions, instead, if the asset is owned by the leasing company, so the lessor, who happens to be profitable, they can actually take advantage of these deductions, and then because they are benefiting from these deductions, they will share a portion of that savings or that benefit to the lessee in the form of lower rental payments. So those are some advantages for the lessee. Now let's switch over to the lessor side. So for the lessor, it can result in profitable interest margins. It can help stimulate the sales of products. Someone's not really sure if they want to buy, spend this kind of money on a new vehicle, but if they can lease it and kind of get a feel for whether or not they like it first, that might, help to persuade someone to buy your product or buy your vehicle. We talked already about the tax benefits that you can somewhat take advantage of. And then I put in quotation marks, potential high residual value to the lessor. So this, however, can be risky. It's not always a sure bet. But always the hope is that when you receive the asset back, right, that there is still a considerable amount of value on that asset that you can then use to, enter into a lease agreement with someone else or to sell at a gain, etc. However, this can be very risky, and an example is back when SUVs became really, really popular, Ford was really into leasing these trucks and SUVs. However, once the economy started to deteriorate and gas prices started significantly increasing, no one was interested in a gas-guzzling truck or SUV to drive. And so the resale values and the demand for these types of vehicles plummeted, and therefore Ford was required to take a $2.1 billion write-down. So there's a very quick article that I have posted in Leo that talks about this issue that I encourage you just to spend 2 minutes just reading over to just kind of get a little bit better of a real-world picture regarding this. It is a potential advantage, but it also can be risky and can actually turn into a disadvantage. So when we think about leases, there are a number of different schools of thought. So if we look at a continuum, on the left-hand side of the continuum would be no capitalization. Would mean that you're never going to put anything on your balance sheet. And the opposite end of the continuum is that you are going to capitalize all long-term leases. And so within that continuum, there are different schools of thought. So the first one, which is closest to the no capitalization policy, says that do not capitalize any leased asset because the property is not owned by the lessee. It's simply a form of contract requiring continued performance by both parties. And when we think of continued performance, the lessee is required to have continued performance because they need to make periodic lease payments, and the lessor has continued performance because they need to make that asset available for the lessee to use. Now, if we move a little bit further down the continuum, the next school of thought is, well, let's capitalize leases that are similar to installment purchases because transactions should be reported in accordance with their economic substance, and installment payments are similar to mortgage payments. So let's think about an example here. So let's pretend that you're American Airlines, and you need to buy a new Airbus 320. Now, you have a couple of different options in terms of financing this Airbus. Your first option is to go to Wells Fargo and to take out a loan in order to pay for this airplane. So let's pretend that that's what you do. So then the impact to your financial statements is going to be, okay, I have this asset, so I'm going to debit asset, I have an airplane. I'm going to credit a bond payable, and then I'm going to record periodic depreciation expense, and I have periodic interest payments that I have to make, and then at the end of the term of the loan, I'm going to have to pay back my principal. Or it could be that you're paying a portion of principal and interest along the way. Just depends on the terms of the bond agreement. Okay? Your next option is to enter into an installment sale purchase directly with Airbus that says, I am going to make periodic payments to pay off the cost of my Airbus, and if that was the situation, I'm still going to have a debit to assets. I'm going to have the airplane on my balance sheet as American Airlines. We're looking at it through the eyes of American Airlines. I'm going to be making periodic payments. A portion of that payment is to cover principal, a portion is to cover interest. I'm going to have periodic depreciation. Okay, so then if I look at really the transaction, right, it would make sense to say, well, if it's like an installment purchase, right, an installment purchase basically is like a loan, and so therefore I should capitalize leases that are similar to installment purchases because the transaction should be reported in accordance with really their economic substance, not the face of how that transaction actually works. The third school of thought is to say we'll capitalize all long-term assets as long-term as long as the lease terms allow for the long-term use to use the property. And so the key to this is that if you have a lease agreement where the lease terms are less than 1 year, you are not going to capitalize it. You're just going to expense as incurred. And then the fourth school of thought is to say, well, let's capitalize leases when the penalty for non-performance is substantial. And usually that happens when you have a non-cancelable contractual right or obligation. So going back to my airplane example, regardless of whether we take out a note or we take out debt in order to pay for the plane, or we have an installment purchase with the manufacturer itself, or whether we enter into a lease agreement where we're going to just lease the plane for the next 20 years with the leasing arm of Boeing, regardless of those three, right, the economic substance of all three transactions is really the same. And because it's the same, we should not get to consider in the lease example that asset is not on our books. So said differently, just because we're entering into a lease doesn't mean that should be considered off-balance sheet financing. In all three situations, because the economic substance is the same, they should all be accounted for in a very similar manner. And so what the FASB has decided is that the third bullet point, the one with the star, is the one that is going to determine our capitalization requirements. So before we get to the actual tests to determine capitalization, I just want to point out a couple of minor things. So first and foremost, companies have to identify the characteristics within the lease contract that indicate the transfer of substantially all of the benefits and the risks of ownership. It's also important to keep in mind that the characteristics need to be applied consistently to the lessee and the lessor. So when you're determining whether or not a lease classifies as a financing lease, that determination should be the same regardless of whether or not you're the lessee or the lessor. So if the lessee says it's a financing lease, then the lessor should come to the same conclusion. Or if the lessor says it's an operating lease, the lessee should come to the same conclusion. Regardless, so this is new for this new accounting standard. So regardless of the classification, it's either a financing lease or an operating lease, all leases now show up as an asset and a liability on the balance sheet. So prior to the adoption of this new standard, operating leases had off-balance sheet arrangements, meaning that you didn't see a liability in the liability section and you didn't see an asset in the asset section. Instead, all you ever saw were the periodic rental payments flowing through the statement of cash flows and then showing up on the income statement. Now, how you distinguish between a financing and an operating lease on the financial statements under the new standard is all within how it's presented on the income statement. So, with a financing lease, the lessee is going to recognize interest expense on the lease liability over the life of the lease using the effective interest method. That's the method that we learned in the first week of class. And they're going to record amortization expense, okay, not depreciation expense, but amortization expense of the right of use asset, usually on a straight line basis, over the life of the lease term. Now, total expense, so the combination of the interest expense and the amortization, would be your total lease expense, and that amount is going to be higher in the earlier years of your lease arrangement because the interest expense is higher the higher your lease liability balance is. And your lease liability balance is the highest in the beginning of the years, right? And then as you make those periodic payments, you start to whittle down that balance and interest becomes less and less. It's just like a mortgage payment on a house, right? You have an outstanding mortgage. In the first years of that mortgage, you're paying more towards interest than you are towards principal. And then as you start to pay down that mortgage, more and more is going to principal and less to interest. If you have an operating lease, the lessee is going to recognize interest expense on the lease liability over the life of the lease using the effective interest method, but amortization expense for the right of use asset is calculated so that total lease expense is constant every period. So in this situation, we're going to have consistent lease expense every single month or every single year, and as our interest expense goes down, because our lease liability is decreasing, our amortization expense is going to go up. And they're going to offset each other so that we end up with a total lease expense that is constant over the life of the lease. Okay, so now we're ready to actually look at the criteria for determining whether or not a lease is going to be classified as a financing lease. So, first and foremost, the lease must be non-cancelable. Okay, so it absolutely has to meet that criteria. And then, after that, it needs to meet just one of the following. So the first is the transfer of ownership test. And this is very black and white. It is going to be spelled out in the contract whether or not the asset or the property is going to revert back to the original owner or not. Now, the remaining 4 tests we're going to talk about in detail on the next slides. I also just want to point out, in brackets are the names of those tests under the old leasing standard. So the new lease standard was not a complete rewrite and a complete change over the old standard. It took some components of the old standard and tweaked them, and this is one of those instances where it slightly changed the names of the criteria tests, but the tests in and of themselves are primarily unchanged. So the four other criteria that we're going to look at are the purchase option test, so whether or not there's an option at the end of the lease to buy the property for a bargain price. We're going to look at the term of the lease. So we're going to look at the proportion of the lease term to the total economic life of the asset or the property. We're going to look at the present value. So the present value of the lease payments compared to the actual value of the property. And then finally, the alternative use test. So the purchase option test, also known as the bargain purchase option, is an option where the lessee is going to be able to purchase the leased property for a price that is significantly lower than the property's expected fair value at the date the option becomes exercisable. So this would be disclosed within the lease document. So at the beginning of the lease, the difference between the option price, which will be in the lease document, at the end of the lease, and the expected fair value must be large enough that electing the purchase option is reasonably assured. If there is a bargain purchase option, then the asset is going to be amortized over the economic life of the asset and not the lease term. So the gist of this test is basically saying, okay, if I'm going to lease this asset for 5 years, and at the end of the 5 years, it still has 5 more years worth of useful life, and whoever is leasing this to me is going to allow me to buy it for $2,000 when the expected Kelly Blue Book value at that point in time is $50,000. I'd be a fool not to buy it because I need another asset. This one's going to be a lot cheaper. So then you're going to factor that extra payment of $2,000 into the calculation of determining your lease liability. But more importantly, you're also going to say, well, my term of my lease is 5 years, but I'm not going to amortize my asset over 5 years. I'm going to amortize it over 10 because that's the number of years that I'm actually expecting to derive benefit from it. And then the bargain purchase cost is factored into the lease liability and the right of use asset valuation, as I mentioned previously. So if we look at an example, Brandon's Delivery Service leases a Chevy Equinox for $599 a month for 40 months with an option to purchase the vehicle for $100 at the end of the 40-month period. If the estimated fair value of the Chevy is $3,000 at the end of the 40 months, the $100 option to purchase is clearly a bargain. Okay, the next test is called the lease term test. And what this test is saying is that if the lease period equals or exceeds 75% of the asset's economic life, the lessor is essentially transferring most of the risks and rewards of ownership to the lessee, and therefore the lease is a financing lease. Now you might be thinking to yourself, well, that's a super easy calculation. But determining both the lease term and the economic life isn't always clear-cut. While we generally think of the lease term as to be the fixed, non-cancelable term of the lease, there are options to renew, bargain renewal options that can always extend the lease period. So if you have a bargain renewal option, it allows the lessee to renew the lease for the rented item that is lower than the expected fair rental price at the date the option becomes exercisable. So again, similar to a bargain purchase option. Now, again, following kind of the same guidelines for a bargain purchase option, at the inception of the lease, the difference between the renewal rental rate and the expected fair rental rate must be great enough to make the exercise of the option to renew reasonably assured. And then when it comes to economic life, right, we know that, you're using prior history to determine, how long you think an asset is going to be able to be used for, but if you're in a heavily reliant technological industry, we know that, with how rapidly technology is changing, that it can be challenging to determine what a useful life might be. So while this seems like a very cut and dry, black and white test, there are always some complications. Excuse me. And then finally, if a lease starts during the last 25% of the life of the asset, this test cannot be used to determine whether or not a lease is going to be classified as a financing lease. Now let's move on to the present value test. So if the present value of the minimum lease payments equals or exceeds 90% of the fair value of the asset, then the lessee should capitalize the leased asset, because in the substance of this transaction, they're practically buying the asset. Now, when it comes to the minimum lease payments, we've got the minimum rental payments, any guaranteed residual value, any penalty for failure to renew or extend, and any bargain purchase option. So all of these need to be factored into the present value test. So the residual value is very similar in nature to the residual value that we see when we're dealing with the purchase of fixed assets. So it's the expected value of the leased asset at the end of the term. Now when it comes to leases, residual values can be guaranteed or unguaranteed. And a guaranteed residual value means that the lessee is obligated to return that asset, and it has to be worth at least the amount of the guaranteed residual value. If the asset is not worth that much, they must pay in cash the difference to the lessor. When you have a penalty for failure to renew or extend, that's an amount that the lessee is going to pay if the agreement states that there must be an extension or a renewal on the lease, and the lessee decides that they don't want to do that. And then the final piece of this puzzle that we need in order to determine the present value test is to figure out what we're going to use for a discount rate. So, the discount rate is the present value of the minimum lease payments using the incremental borrowing rate. Now, typically, it's the incremental borrowing rate of the lessee that is going to be used. And when we talk about the incremental borrowing rate, it's saying if instead of entering into a lease, I had gone to a bank and gotten a loan to outright purchase this asset, what interest rate would I have received from the bank in order to fund this purchase? Now, the caveat to this, to using the incremental borrowing rate, is if the implicit interest rate used by the lessor is known and it happens to be less than the incremental borrowing rate used by the lessee, then the implicit rate must be used instead. Now, the implicit rate used by the lessor is the rate where the present value of the sum of the minimum lease payments and any unguaranteed residual value equals the fair value of the leased property to the lessor. The reason that this rule exists is that if you just come up with a really high incremental borrowing rate, okay, that means that the present value is going to be a lot lower because you're having higher interest payments, and using an artificially high incremental borrowing rate can force the present value of your minimum lease payments to be artificially lower, which would then indicate that you are not, or that those present value payments are less than 90% of the fair value of the leased asset, and therefore you would fail this test and get to have operating lease treatment. Now, in the past, some companies felt that operating lease treatment was preferable because it resulted in off-balance sheet arrangements. With the new standard, that is no longer the case because even operating leases have to go on the balance sheet. And then finally, the last test is the alternative use test. And this test is new under the new standard. It did not exist under the old leasing standard. And the alternative use test says that if the lessor does not have an alternative use for the asset at the end of the lease term, then the lessee should classify the lease as a financing lease. And what the thought process behind this one is that, well, the lessee has used up all of the benefits that have been derived from the asset, and as a result of using them all up, therefore they inherently must have purchased the asset. You really only see this when you are having build-to-suit arrangements. So, where something is made or manufactured and it needs to be customized, and it can't be, that can't be undone, or it's proprietary and therefore no one else, the lessee doesn't want anyone else to be able to have access to it, etc. Okay, so now we've gone through the capitalization criteria, and remember, the criteria is, first and foremost, it has to be non-cancelable, and then one of those following 5 criteria had to be met. Not all of them, just one of them. So this next slide really just kind of is an overview of the accounting treatment, but what I'm going to do instead is focus on a specific example on the next couple of slides. Okay, so first we're going to look at a financing lease from the perspective of a lessee. So our lessee is Vienna Construction, and our lessor is John Deere Financial Corp. So John Deere and Vienna Construction sign a lease on 1/1/2017 that calls for John Deere to lease a front-end loader to Vienna beginning on 1/1/2017. Facts about the lease are as follows. So our lease term is 5 years, and the lease agreement is non-cancelable, so that is the first check mark on determining that we have a financing lease. It requires annual rental payments of $20,711.11 at the beginning of each year. So this is key because we know that when we make periodic annual payments, that they can be due either at the beginning of the year or at the end of the year. If they're at the beginning of the year, that's an annuity due, and if they're at the end of the year, it's an ordinary annuity. The loader has a fair value on 1/1/2017 of $100,000, an estimated economic life of 5 years, and a guaranteed residual value of $5,000. But the owner expects the residual value will be greater than $5,000 at the end of the lease term. Some more facts about this. The lease contains no renewal options. The rotor is going to revert back to John Deere at the termination of the lease. Vienna has an incremental borrowing rate of 5%. Vienna depreciates on a straight line basis similar equipment that it owns. And John Deere set the annual rate of return on its investments to 4%. So the implicit rate for John Deere is 4%, and Vienna knows that. So the first thing that we want to do is we need to run through the criteria to determine whether or not this should be classified as a financing lease or an operating lease. So the first check mark we know that we made was that it is non-cancelable, so that's good. And now we need to focus on whether or not there is a transfer of ownership. And we know that answer to that is no. They tell us that the loader is going to revert back to John Deere at the termination of the lease. We also know that there is no option to renew or to purchase. The lease term test so the economic life of the asset is 5 years, and the lease term is also 5 years. So at least 75% of the life of the asset we will be leasing it for. So that test is met. So we're saying yes to that. Now, at this point, you could actually stop doing the calculations. But for the purposes of going through this example, I'm going to run through them all. So then next is the present value test. So we know that the fair value of the loader is $100,000. The present value of the payments happen to also be $100,000. And so the answer to this test is also yes. And I'll go through in just a minute how I got to the present value of the payments. And then the alternative use test, no, the asset reverts to John Deere, and we're anticipating it to have some remaining residual value. Okay, so how did I get to the $100,000, which was the present value of the rental payments? So if I go back one more slide here, oops, they tell me that I need to make periodic rental payments of $20,000, $711.11. So what I need to do, and I'm going to be making 5 of those payments. So what I need to determine is, using the annuity due table, I need to look at what the present value of an annuity due is for 4% and 5 years. And that answer is going to be something like $95,890.35. Then I also know that there is a guaranteed residual value of $5,000. So what I also need to do then is I need to take the present value of $5,000 discounted at 4% for 5 years. And this is just a single sum, and this results in an amount of $4,000 $3,000 $4,109.65. And again, that is the present value of $5,000 discounted back at 4% for 5 years. So that's how I calculated that the present value of my minimum lease payments plus any guaranteed residual value is equal to the fair value of the loader, which is $100,000, and therefore the 90% test was met. Okay, so the first journal entries that I'm going to take a look at are from the perspective where I am the lessee. So because John Deere's implicit interest rate of 4% was known, and because it was lower than my incremental borrowing rate of 5%, I am going to use their rate in order to determine the lease liability that I need to record. And so that lease liability is the periodic interest payments of $20,711.11 times the present value annuity factor for 5 years of 4%. Now, what is not being factored in to my lease liability is the guaranteed residual value. And the reason that I don't have to factor it in is because I have proof, or I have expectation that the expected residual value is going to be greater than the guaranteed. I'm not going to have to make any additional payments. So I'm going to credit my lease liability for $95,890.35, and I'm going to debit my right of use asset for $95,890.35. Okay, it's important that my right of use asset be separated from any of the other assets that I outright own. And so what you'll often see is ROU asset or right of use asset. Okay, so my lease started on 1/1/2017. I basically grossed up my balance sheet. I recorded a liability with a corresponding asset. Now, I also, however, have to make my first lease payment. So I'm going to debit my lease liability or leased liability, either one works, and I'm going to credit cash. Now, keep in mind that within that $20,711.11, there's two components. There's the reduction of the lease liability, and there's also a component for the financing cost, the interest expense. Now, because this is the first payment and I literally just entered into this arrangement, the entire amount of my cash payment is going to reduce my lease liability. Now, on this next slide here, we have our lease amortization schedule. So we have our annual lease payments. We're making 5 of those. We have our interest on our liability. The difference between our annual lease payment and our interest on our liability, which is always calculated at 4% of the prior year balance, is going to be our reduction in lease liability. And then in column D is our running lease liability. So a couple of things to know. By the time you get to the end of your lease, that lease liability balance should be 0. This is very similar to the amortization schedules that we would have done with bonds back in week 1. Okay, at the end of the year, we are going to record our accrued interest. So we're going to debit interest expense and credit lease liability. So for 2017, if we go back a slide, right, it's going to be the amount from the 1/1/2018 row. Then, also don't forget, this is actually incorrect here. It says Vienna records annual depreciation expense. It is not depreciation. It is amortization expense that is going to be recorded. So I will fix that on the slides. Okay, we're going to take our right of use asset, divide it by the number of years of the lease term, which happens to be 5, gives us $19,178.07 per year. We're going to debit amortization expense and credit the right of use asset. Then if we look at what happens with our balance sheet as of 12/31 of 2017. We don't have any current assets. We have a current liability of $20,711.11. That represents the reduction of the lease liability that we're going to see in the next year. That happens to correspond with the payment that's due on 1/1/2018. For long-term assets, we have our right-of-use asset less our accumulated amortization, gives us a net leased asset of $76,712.28. And then we have our long-term lease liability. Okay, our second payment, debit the lease liability, credit cash. You're going to see those same payments every single time for each of those 5 years. Okay, then what happens when we have our lease expiration? So on 1/1 of 2021, Vienna will have fully amortized the amount capitalized as leased equipment and fully discharged its lease obligation. Because Vienna is not purchasing the loader, it's going to return the equipment to John Deere. Okay, and be done with it. Now, let's pretend that on the last day of the lease, that John Deere comes to Vienna and says, oh, you can buy this equipment for $3,000. And Vienna says, you know what, I want to because I think I can get another 2 years out of this equipment. So, all of the other entries that have happened in the last 5 years are going to stay as is. Then what we're going to do is we're going to debit equipment or whatever type of asset it is, and we're going to credit cash. And in doing so, right, we've now actually put this on our balance sheet as an owned asset, not as a leased asset. And we would proceed to depreciate it then over the next 2 years. Okay, so now let's take a look at the lessor accounting for financial leases, or for finance leases. So I mentioned before that the lease classification tests for the lessor are identical to the test used by the lessee. And again, the reason for this is that we're trying to determine whether this agreement results in the transfer of control. And if it has, right, then what that means is that the lessee has gained control and the lessor has given up control, right? Two parties can't own the same asset at the same time. Now, the only other kind of caveat to the tests for the lessor are that the lease classification tests also need to cover revenue recognition, because when the lessor transfers control of the leased asset, the performance obligation has been satisfied. And then as a subset to revenue recognition, which we covered last week, the lessor needs to evaluate the collectability of the payments from the lessee. And if payment is questionable, you are not going to record a receivable or de-recognize the leased asset. And when I say de-recognize the leased asset, what I mean by that is literally showing it as a sold asset. And instead, the receipt of lease payments under financing leases are going to be recorded as a deposit liability. So we're going to use the same facts presented for the lessee side on the accounting for the lessor side. So it's run through the same classification tests. It's determined that this is a financing lease. They're going to remove the asset and record a lease receivable. So when I say they're going to remove the asset, that literally is I need to credit inventory and I need to debit cost of goods sold. I need to credit sales revenue and I need to record a lease receivable. So we're going to assume that this loader cost John Deere $90,000 to manufacture. So the lease receivable is calculated as the present value of the rental payments plus the present value of the guaranteed or unguaranteed residual value. So as I mentioned before, that's how you get to the fair value of this agreement. So the The journal entry is going to be a debit to lease receivable of $100,000, a credit to sales revenue of $100,000, debit to cost of goods sold of $90,000, credit to inventory of $90,000. Okay, now the lease amortization schedule for the lessor looks a little different. And the reason for that is at the end of the lease term, the lessor has a guarantee that the asset will be worth at least $5,000. Now, the lessee thinks it absolutely will. So, how I want you to think about it from the lessor's perspective is that at the end of the lease term, the lessor is guaranteed either an asset that's worth $5,000 or cash in the amount of $5,000. So if they're going to get cash, right, that acts as almost like an annual lease payment. Or if they're going to receive an asset that's worth $5,000, then they could turn around, right, and basically sell that asset for $5,000. So either way, they have a sixth payment of $5,000, which is also why the lease receivable that they're recording is for $100,000, not for the $95,890 that the lessee recorded. Then we have our various journal entries. We've got our first lease payment, we've got our interest receivable, we go to our second lease payment, etc. Okay, so we've run through all of the classification tests, and let's pretend that they did not qualify as a financing lease. Then the lease would be reported as an operating lease instead. Under an operating lease, the lessee is still going to record a right-of-use asset, as well as a corresponding lease liability, but there isn't going to be any amortization expense of the right-of-use asset. Instead, the lessee is going to report lease expense of the same amount each period. The interest expense incurred on the lease liability is recorded within lease expense, and the right-of-use asset sort of amortization is derived by taking the annual lease payment less the interest on the liability. So let's take a look now at an example. In this example, Delta is our lessor, and WeFly4You is the lessee. They sign an agreement on 1/1/2017 for use of an airplane. The lease agreement is non-cancelable with a term of 3 years. The airplane has a cost and fair value of $60,000. The airplane has an estimated economic life of 5 years with an unguaranteed residual value of $12,000 at the end of the lease. There are no renewal options, and the airplane will be returned to Delta at the end of the lease term. The implicit rate of interest by Delta is 6% and is known to WeFly4You. So first of all, let's go and look at why this is classified as an operating lease. So we know it's non-cancelable, so that meets criteria 1. But then if we look at the other criteria, we don't have a transfer of ownership, we don't have a purchase option, our lease term is 3 years, and the economic life of the asset is 5, so that's only 60%. The present value test ends up being $49,924.56, which is only 83.2% of the fair value of the plane, and an airplane is an airplane, and therefore it doesn't indicate that there's a lack of alternative use. So, as a result, none of the tests are met, and therefore we have to classify this as an operating lease. Now, before we go on to how to account for this as an operating lease, let's look at the present value test and see how we came up with the $49,924.56. So, we know that the number of years for this arrangement is 3. we know that the implicit interest rate is 6, and we know we do not know what the periodic payments are, but I can tell you, let's see, they're going to be $17,620.08. Okay, so the fair value of the leased equipment is $60,000. The present value of the residual value, so we know if we go back a slide that the unguaranteed residual value is $12,000. We're going to discount that back 3 years at 6%. That's going to give us a present value of $10,075.44, which means that the amount that Delta needs to recover through lease payments is $49,924.56. Okay, the present value of an annuity due factor at 6% for 3 years is 2.83339, which means that our lease payments are going to be $17,620.08. That then so that represents our annual lease payment, and that $49,924.56 is what was used to determine whether or not we met the 90% test. And as you can see, oops, $49,924.56 divided by 60,000 is only that 83%. Okay, so as the lessee then, we fly for you. We are going to record the right of use asset of the $49,924.56 and a corresponding lease liability for the same amount. Now, this is an example where we have an unguaranteed residual value. So we are not on the hook if this asset is not worth as much money as it needs to be worth at the end of the lease term. Also, because this is an annuity due problem, our first lease payment is due on the same day that we commence the lease, and we're going to make that payment for $17,620.08. Now, in the top right corner here, we have our lease amortization schedule. Okay, so this schedule in the top right is how we are going to amortize the lease liability. What you see in the bottom left corner is how we are going to basically amortize the right of use asset. Now, I mentioned when we have the right of use asset that we are going to have consistent entries every single year for lease expense. So that lease expense, right, is equating to our annual lease payment amount. And what happens is that the combination of the interest on the liability plus the amortization of the right of use asset, which is not really amortization, really it's just a component of lease expense, that the sum of those two is going to remain constant over time, and as the interest on the liability goes down, the amortization of the right of use asset is going to go up. And what you'll notice here is it's just an inverse, basically, relationship between the interest on the liability in terms of lease expense and the lease amortization schedule. So the interest on the liability for the first year is equal to interest on the liability from the lease amortization schedule that is paid on 1/1 of 2018. And then the same happens with 2018. It happens to be the amount of interest that's due with the annual lease payment on 1/1/2019. And then by the time you get to the end of the 2019, you have already paid your last payment, therefore there is no interest. Okay, so then here are the various journal entries that you are going to record. Again, they're going to come straight off of those tables from the previous slide. More entries. Okay, so these entries are from the perspective of the lessee. Now let's look at the entries from the perspective of the lessor. So, on 1/1 of 2017, you are basically receiving cash, but you're receiving cash up front for the right to use the property for the next year. So debit to cash and a credit to unearned lease revenue. Then at the end of the year, you are going to get to recognize that revenue, so debit unearned lease revenue and credit lease revenue. And again, the reason for this is because the payments are due at the beginning of the year versus at the end of the year. And then because you're the lessor, you do need to record periodic depreciation expense. Okay, now let's take a couple of minutes to look at some unique leasing considerations. So we've talked in a couple of our examples about residual values, and we've looked at examples where it was guaranteed versus unguaranteed. So recall that a residual value is the estimated fair value of the leased asset at the end of the lease term. Usually you're going to see a significant residual value at the end of a lease term when the economic life of the leased asset exceeds the lease term. I already talked about how a residual value can be guaranteed or unguaranteed. If a residual value is guaranteed, it means the lessee is agreeing to make up any deficiency below the stated amount. This is very common in agreements because it protects the lessor against any loss in estimated residual value, and it therefore also guarantees a desired rate of return on their investment. Now, if it is probable, so thinking about this from the perspective of the lessee, if it's probable that the expected residual value is either equal to or greater than the guaranteed residual value, then the lessee does not include the guaranteed residual value in the computation of the lease liability. So you're going to include the residual value in the calculation for the present value test, but not in the computation of the lease liability. So that is the case in the example that we looked at between John Deere and Vienna. Now, if it is probable that the expected residual value is going to be less than the guaranteed residual value, then the difference between the expected residual value and the guaranteed residual value needs to be included in the component, in the computation of the lease liability, and it needs to be discounted back to present value. The guaranteed residual value acts like an additional lease payment that they're either going to pay in property, cash, or both. So let's look at an example now where the expected residual value is below the guaranteed residual value, and we think that the expected residual value is going to be $3,000 when the guaranteed amount is $5,000. So that under those circumstances, Vienna needs to include an additional $2,000 as a lease payment in determining the lease liability and the right of use asset. So we're going to have a slightly modified lease amortization schedule. We're going to show an extra payment of $2,000, and we're going to compute the present value of that residual payment of $2,000. As a result, our right of use asset and our lease liability is a little bit higher, but our periodic lease payments, at least the 5 original ones, are going to remain the same. At the end of the lease term, Vienna gives back their asset, and let's assume that at the end of the lease term, they decide that, it's not even worth $3,000, it's only worth $2,000. So we're going to debit the lease liability for $2,000. That is going to discharge the remaining value left on the lease liability. We need to record an extra $1,000 loss of $1,000, and then we're going to pay out cash of $3,000. Okay, when we have unguaranteed residual values for the lessee, from a lessee's perspective, it's going to be treated the same as if no residual value existed at all. And at the end of the lease, you just return the leased asset to the lessor and no additional payments are required. When you have a lessor and you have an unguaranteed residual value or a guaranteed residual value, you are going to work under the assumption that the lessor is going to realize the residual value at the end of the lease term, regardless of whether it's guaranteed or unguaranteed. As a result, then you're going to recover the same amount through your lease payments. The only difference between unguaranteed and guaranteed residual values are that you can only recognize sales revenue and cost of goods sold for the portion of the asset for which recovery is guaranteed. So let's assume that the sales price is $100,000, the expected residual value is 5, so that's the future value, the present value is the $4,109.65. The equipment that's going to be leased has an inventory value of $85,000. So if you are operating in a situation where you have a guaranteed residual value, you're going to have a lease receivable of $100,000, the sales price or sales revenue is $100,000, your cost of goods sold is going to be $85,000, and your inventory is going to go down by $85,000. You're going to end up with gross profit of $15,000. However, when you're in an unguaranteed residual value situation, your lease receivable is still $100,000, but your sales price or your sales revenue is only the $95,980.35. Sorry, $95,890.35. And the difference there is you need to subtract out the expected residual value because, as I said, it's unguaranteed. You're going to do the same thing with cost of goods sold. Now, as a result of that, you're still going to end up with the same gross profit, but you'll just have lower sales revenue and lower cost of goods sold. And the thinking behind this is that if the asset isn't worth the residual value at the end of the lease, it would not be appropriate to recognize the revenue and the associated cost of goods sold for that amount. Sometimes when we enter into lease agreements, we have executory costs. These are expenses that are associated with owning an asset, such as property taxes or insurance. How we account for these types of costs depends on the lease structure. If we have a gross lease, that means that embedded within the lease payments to the lessor are payments to cover some of these executory costs. And therefore, these costs that are included, because they're included in lease payments, they're also included then in measuring the lease liability. The other option is a net lease, where the lessee is either making the variable payments to a third party or separately to the lessor. And in these situations, you do not get to capitalize these costs, and instead you expense them as incurred or when incurred. Sometimes we also have lease prepayments or incentives. So if you think back to all the examples that we've looked at so far, we have determined the value of the right-of-use asset based upon whatever value we determined for the lease liability. And so that's the first step in the process. The second piece then is to make adjustments to the right-of-use asset for these prepayments, incentives, and other initial direct costs. So the formula really is basically to say, take the initial measurement of the lease liability, add in any prepaid lease payments, subtract out any lease incentives received, and add in any initial direct costs to derive what our beginning or lease inception right-of-use asset should be. Now, when it comes to initial direct costs, what is important is that these costs have to be incremental. And by saying they're incremental, they would not have been incurred if we had not executed this lease arrangement. The other important thing to keep in mind is that these costs have to have been incurred basically at or after the execution of the lease. So costs associated with negotiating the lease terms are not considered because they were incurred before the execution of the lease. So these might be like legal fees or filing fees that you have to do as a result of executing the contract, but not as a condition to execute the contract. I'm not going to go through this example, but you can look at it for yourselves. But this basically goes through, if you have prepayments or incentives, how do they factor into the calculation of the right-of-use asset? And then in terms of presentation on the financial statements, the lessee and the lessor have to show a variety of items. So if you're the lessee, you're going to show your right-of-use asset and your lease liability on the balance sheet. If you have a financing lease, you're going to show amortization expense and interest expense within the P&L. If you have an operating lease, you're only going to be showing lease expense. If you're the lessor and you're operating under an operating lease, your asset that you're leasing out is going to remain on your balance sheet. So then you're going to record depreciation and revenue, usually on a straight line basis. If you are operating under a sales type lease, so a finance lease, you are going to show a lease receivable, and it's important that you identify that from other types of assets. And also keep in mind that that leased asset, that underlying asset, is going to be derecognized, meaning it's not going to show up within the asset section of your balance sheet because it's basically or essentially owned by the lessee. And then your income statement is going to reflect interest revenue, and then your selling profit or loss, which is your sales revenue minus your cost of goods sold. Some disclosure requirements for the lessee, a general description of the nature of the leasing arrangements, how any variable lease payments are determined, the terms and conditions for options to extend or terminate leases, whether or not there are residual value guarantees, any significant assumptions or judgments. These usually pertain to the discount rates being used, your total lease cost. For your financing lease cost, the breakout of the amortization of the right-of-use asset and the interest. You need to also show your operating and short-term lease costs. So again, remember that if you have any arrangements that are basically less than 12 months, you are not going to capitalize those. Instead, you're going to expense as incurred. So that's your short-term lease cost. You need a weighted average. You need to show the weighted average remaining lease term as well as the discount rate. And then you also need to show the timing and amount of your cash inflows or outflows associated with your leases. So if you're a lessee, kind of what payments you expect to make over the next 5 years. What I've included now at the end of the slide deck is just a sample disclosure. This is from Marriott's Q1 10Q. So this is under their new standard. So you can see here that they have outlined their operating lease cost and their variable lease cost. They indicate that most are 20 years with options to renew for 5 or 10-year periods. They do not consider those renewal options in their calculations because they are not reasonably certain that they will exercise those options. For Marriott, most of our leases are for land and or buildings for hotels that we have. And so for them, there's usually a component of the lease expense which is variable and is largely dependent on the performance of the property. Moving on, here is a table that shows how much we have to pay out in each of the next 5 years, and the breakout between the operating leases and the financing leases. And then it tells you down here the weighted average remaining lease term between our operating leases and our financing leases, as well as our discount rate. And then here is where it tells you within our balance sheet where you find our lease liabilities. So we have our operating leases and our financing leases. Depending on whether they're current or non-current, you can see that they're either in accrued expenses and other, or long-term debt, etc. So this is just kind of, these lines aren't necessarily big enough for their own lines on the balance sheet, so they're telling you within the balance sheet where you can find them. And then this basically at the bottom is just supplemental information that shows you how the lease payment amounts show up in the statement of cash flows. And then finally, this is just an interesting article, I thought. So the impact of the new standard. So many of you probably have heard about a company called WeWork, and they basically have workspace where people can go and rent it out for a day or an hour or more long term. If someone doesn't have space to work at home, or they want to get out into a more office-like environment. And so one of the things that WeWork is looking at is they filed an S1 to potentially go public. But as a result of this new accounting standard, they have had to put a lot of here we go. They've had to put a lot of their leases on their balance sheet, which has, made them look not as attractive to potential investors. So I linked this article there. If you get a chance, I highly recommend taking a few minutes to read it. It's just interesting to see, how the new lease standard is impacting different companies.